Like you mentioned, I am Luke from Loopscale. I am one of the co-founders, and I was very excited to kind of dig into some technical details behind lending markets, but did not have enough time to fit it all in, so I really wanted to focus on more of the financial structuring side of things and kind of how we at Loopscale are thinking about it and some of the other cool things going on in the industry as it relates to credit. What I wanted to start with here was really thinking about where credit fits into the broader financial ecosystem. It's not necessarily something that people associate with, super positive component to everybody's lives, but ultimately the piece of the financial system that is the lowest risk and the most scalable ultimately is credit. The use case of this, right, is moving funds from a less valuable source of investments is something that's a little bit more productive, and in doing so, leading to significant economic growth in places that are a little bit more robust in how they allocate credit. So these are a couple diagrams that ended up being a bit more blurry than I'd hoped, but Thea, great research fund, kind of came up with a few data points that I think illustrate this point very well. Ultimately, places that both have more credit extended to private industry saw significantly higher economic growth, as well as places that had lower credit spreads were able to, again, generate a lot more activity within their economies. And I think that's for good reason. Ultimately, the less it costs to do something, the more that thing is going to happen. And in crypto, we sort of have a more bespoke set of problems that go into credit, but also a lot more flexibility in how we allocate credit. So a lot of what we think about is sort of the different parameters along which credit might be constrained and where we might see some of that growth in the future. I think we've done a really good job in this space of allocating credit to things like leveraged trading, different speculative use cases, especially ones that are backed by really big pieces of collateral that have tons of liquidity and whatnot. But as this industry grows and we have a lot more interesting economic use cases, things like payments, DPIN, MEV, whatever it may be, all of these economic activities still rely on sort of that same underlying credit need that the rest of the economy is powered by. So if we want to see these things start to grow, we'll hopefully end up seeing a lot more credit extended to them. But ultimately, the reason that we haven't seen a lot of that, both is a technical problem, it is very complex to build these systems, and then a financial reason, which is there are a lot of things that go into making these decisions that we need to be able to account for and underwrite for in order to allocate credit to these different types of products. And so kind of how we have thought about this over time is if you think about Uniswap as effectively like a simulation of how a market maker might end up pricing an asset based on just the total available assets that are outstanding and sort of the relative value that people subscribe to them. Phoenix and some of the intent-based trading protocols have ultimately given us a much more granular and hands-on way to determine that value, which leads to more liquidity, more assets that can be supported, and a lot more active markets in general. Similarly, Aave and some of these more pool-based lending models are very much approximations of what a credit agreement might look like. There's a limitation to kind of how broad you can end up being with the assets that you support and the types of credit that you can extend. And so what that ultimately manifests itself into is a number of issues. One being it requires a lot of capital in order to determine rates that are somewhat efficient. And so what that means is the only assets you can support are assets that you can get enough of in deposits and enough of in borrowed volume where a rate is actually meaningful and people are able to actually start taking advantage of the capital being on chain in the first place. You have a lot of capital that's sitting idle in these pools, things that are, maybe one lender might have some risk assessment of the collateral that's being posted and would be willing to extend more credit at higher LTVs or lower rates or whatever it may be, and borrowers who would maybe be taking advantage of those rates if they existed, but ultimately that capital can't be put to work just due to the inherent architecture of these systems. The second piece is, as I mentioned before, the scale and the types of assets that are coming on chain are growing quite a bit. I mean, we've talked a lot about institutionalization of the space. space. You have like these new money market funds and things like that that are coming on chain, but you also have a lot of more fundamentally complex assets that end up being a bit more, robust in the type of credit agreements that need to be set up in order to work with them. Things that have lower liquidity, can't be traded as easily on chain. And finally, you commingle these assets. You ultimately are rehypothecating a lot of collateral, and that creates downstream risks for the people who are either liquidating these things or lending against them. And so what were we thinking about kind of as we got into this space? A lot of it came down to, what assets can you support? How efficient can you be with your collateral? How composable can you be with other things that want to just slot you in as one small component of the stack? And then ultimately, how much management over risk can you have? What things can you highlight, restrict against, allocate at different rates and LTVs to, et cetera. And so just kind of thinking about the different terms that you have access to configuring as an individual lender and an individual borrower. Basically, all you can say is, hey, I've got this thing, and I want to borrow some of that other thing. And at the end of the day, you're sort of at the whim of what either a protocol or a manager, or whoever it may be, subscribes to that. Really what we wanted to dial down on was this concept of a loan being the core primitive behind whatever macro structures on top of that you want to create. And that involves a lot of things that need to be configurable on a per lender borrower basis. So that's LTVs, oracles, liquidation criteria, repayment schedules, loan to value with cross-collateral combinations, the durations that you're going to lend these things for, et cetera. And ultimately, none of this is like reinventing the wheel or anything. Credit has been a thing for 10,000 years, and people have done a really good job at, refining what information they need in order to make decisions. Some of that's expanded by the new things that are, have been built within crypto and the new tools we have for recourse and whatever it may be. But ultimately, a lot of these things are still very important and just can't be reflected on chain due to the complexity of the information required in order to do that. And so that's a lot of what you get by really boiling things down to their most basic primitive. So the way that Loopscale works specifically, and the way that we think about implementing something like that is lenders and borrowers are setting all the different criteria that they care about. Right at the end of the day, it comes down to all those things that I mentioned previously. Those are getting placed on an order book. That order book then runs through a matching engine. You're looking across all those parameters, less than, greater than. It's not necessarily like a trading order book where you're just straight up on two parameters, basically matching on price. Ultimately, you care about a lot of things, and so being able to accommodate for that is what the matching engine does. Implements that agreement into a loan. That loan is then custodying the assets, managing all of the different repayment schedules, whatever it may be, and then ultimately, if recourse is needed in some form, a default or a liquidation or whatever, you have external agents that are taking care of that. And so thinking back to some of those issues that I brought up before, on the rates side, you have a lot of capital sitting around doing nothing, like I said. That really comes from the fact, one, that you need the cushion from a usability perspective, but most importantly, you're sharing risk across lenders. So all lenders are opting into the same risk profile, and all borrowers then are exposed to other more risky borrowers' lending profiles, similar to like an insurance model, right? Everyone's kind of the sum of their lowest part. And so that's sort of what you see today in DeFi. With an order book structure like this, while it is a bit more complex to get into that loan agreement in the first place, once you're there, things work sort of as efficiently as possible. You have as much customization over what each of these individual agreements looks like. And I'll kind of get into how we solve some of the usability problems with that very soon. The next piece of this is the commingling. We talked about where those issues might come up. And the kind of core solution for this is let each individual lender and each individual borrower decide what those things are that they want to expose themselves to. And this, if there is a bunch of liquidations, you're not pulling assets out of one borrower's collateral to repay somebody else's loan. At the end of the day, everything is sort of siloed based on how people are interested in engaging. And then most importantly to us, asset scale. So we want to be able to support all the assets that are coming on chain, especially the more bespoke ones, payments, DPIN, whatever it may be. And again, as I mentioned, liquidity and usability, these are the two most important pieces of all of these crypto native products. And there's been tons of attempts at order books before, but ultimately they're very difficult to use. And so a lot of what we do is sort of abstract the specifics of the order book, leave that more at the infrastructure layer, and then give the end user something that's much more easy to use. And so we have advanced lending positions. These let you spread assets across a bunch of different parameters at once. Virtual markets, these are things that sort of give the end user the ability to see cross sections of the order book at any point in time. Vaults, which allow people to pool deposits, another person to manage them, and sort of allocate across the order book like that. And then finally, structured products, so basically flash loans with this. And then last but not least, all of this is really focused on how we expand credit across all of these different use cases, and we think a ton about this. We have integrations with all these folks, really focused on what the next generation of on-chain economics looks like. But I went a little bit too long there early, but I really appreciate all you guys chatting, and yeah, come check us out at loopscale.com.